This conference will now be
All right, good day,
recorded.
everyone. I am Steve Saminsky on behalf of Wealth Foundations Northwest. I'd like to welcome you all to the Weekly Prepper. Happy to be here with all of you. Just a quick reminder that your trades are yours, not ours. We don't act as advisors in any way, shape, or form. Trading does, in fact, involve risk. So I am doing the Weekly Prepper to start what I believe will be a normal schedule this week. And so we'll add that into this week and next week. So not just the Weekly Prepper, we're going to do a normal schedule this week as well for members. Okay, so seasonality is going to continue as we get into April, and we could slide this over here as we get into we're into April here, and choppiness, not mixed messages here with our seasonality chart, and don't really know what to expect right away. We might have a big rally, we might have more of a dip, and that's kind of what the market's flashing us right now. Anyway, so oil jumped to new highs after the Trump speech last week, and talks about how they'll hit them hard and that sort of thing. It isn't leading to any soothing of the markets right now. We had a negative correlation between oil and the markets that decoupled a little bit. You're still going to see some correlation there as oil goes up, the markets maybe stay weak or vice versa. But markets remain very dicey, very choppy right now, and they've been mostly been going down for the last month or so. 10-year bonds are up to 4.42%, which isn't good for the markets because now you have something competing for yield that is more risk free. But the economic data reports look strong, so it's really hard for the markets to fail completely and fall apart when the economy is still pretty decent and the jobless claims are okay and things like that. Unemployment rate 4.3%. So you'll notice that the selling doesn't look like panic selling. It looks like a very orderly sort of correction. And in fact, last week that was interrupted by all the major markets being up, including gold, including Bitcoin, including everything. And so even though oil was up, energy was down overall. All the other sectors were up. Staples were not the best other than energy, and tech was. So could tech start to drag us out of here? So over the last week or so, tech has been doing okay. Basic materials, communications, still strong, and energy was the weakest over the last week. Consumer cyclical, healthcare, materials were not great on Thursday, the last day that the market was open. We were closed for Good Friday, so a holiday shortened week. But overall, you can see the strength with some of the mega cap stocks: Meta, Google, Nvidia, Microsoft, even Apple, which has been pretty weak, is bouncing back a little bit. And so, the relative weakness in energy and in Tesla and some of these other very specific places. Telecom overall pretty weak last week. So this is the weekly heat map, not the daily. This is the weekly heat map. So looking ahead, will the relief rally that we've had here get legs, or was it just that, just a typical relief rally within the context of a bearish trend? Really hard to tell. Oil prices still running hot. Volatility still persists. The war news can swing in both directions or in either direction, and that's probably the biggest risk we have going forward. Is we've got Trump's major ultimatum that there has to be a deal and open the Strait of Hormuz or something by Monday, or else he's going to, bomb like crazy on Tuesday. So that's hanging over the markets. Not a great time to put on a lot of new big trades in either direction until we get resolution on that. We do have ISM on Monday, durable goods on Tuesday, FOMC released the minutes on Wednesday, the usual stuff, jobless claims, but also throw in some inflation data. So that puts some risk in the markets too. CPI, PCE can be market movers. The consumer report from University of Michigan, and don't overlook the GDP. GDP tells us if we're heading for a recession or not. So if the GDP is still positive, we don't have a recession. Guess what? So then not a lot of earnings. Earnings is going to be starting to ramp up again. So rating the sectors this week, I'd say that XLE is probably strong coming this week. That could change. Moderate XLU, XLB, and then everything else has been kind of weak if we're looking forward to this next week. But all of this could change. It's really kind of hard to peg what to expect, but just going based on the charts and that sort of thing is what I base this on. So so that's all for the slides for now. Let's go ahead and look at our our model portfolio, which is up on the year, well outperforming the market, of course, which is down on the year. And given we probably should clear the decks. We have a lot of trades, some of which went ahead and went to assignment and exercise. And I think that was really a function of me traveling and forgetting that there would be no opportunity on Friday to close these things out, to be honest with you. So Thursday was the last trading day of the week, and I ended up getting assigned an exercise and a couple things. It worked out fine. It's not a big deal. Just got to close everything out. So I think I'm probably just going to clear the decks completely, close everything out, go to cash, and let things settle out with the war. I mean, cash is a strategy. The only thing I might keep in play is this double-sided trade on the Qs, because that's a trade that we don't mind if it goes in one direction or the other. We're ready for anything, literally, with that double horizontal spread trade. So in short, I'm going to go to cash on everything except maybe the double-sided Q trade, close everything out, and go to cash. We'll get back together Tuesday, okay, Wednesday at the latest, Tuesday or Wednesday at the latest, and we'll put on fresh trades then. Until then, on behalf of Wealth Foundations Northwest, it's been my pleasure to have been your coach today. Good luck at trading, everybody. Take care. Bye-bye.